Hello everyone, this is Lucas from Quant Monitor. About 1 year ago, I built a project that doubled the portfolio on the American indices within just a few months. It was not luck and it was not over-optimization. The key was recognizing the market regime at the right moment. In this video, I will walk you step by step through how I detected that regime, how I used it to filter my strategies, and why that single decision made such a big difference. A market regime simply describes the state of the market. Sometimes the market moves smoothly, rising steadily and predictably. At other times it becomes chaotic, full of sharp swings and false breakouts. Every trading system behaves differently in these environments. When you know which regime you are in, you can adapt your system and avoid the periods that usually cause stagnation or losses. To define the market regime, we only need two classic indicators, a moving average and an average range. The trend is measured with a 50-day simple moving average. If this average today is higher than it was 5 days ago, the market is trending upward. Volatility, which shows how wild the movements are, is measured by the average true range over 14 days divided by the current price. When this value is lower than its long-term average, calculated over 100 days, the market is calm. By combining these two simple ideas, we create a powerful filter that trades only when the market is rising and volatility is low. I applied this filter to my portfolio of American indices, focusing on the Nasdaq market. The strategy entered trades only when both conditions were true, an upward trend and low volatility. The result was clear, a smoother growth curve, smaller drawdowns, and a performance of more than 100% within a few months. You can see the verified results publicly on FX Blue under my name, Lucas Melka. The logic is simple. A rising and calm period known as the up-low vol regime is the ideal environment for momentum and breakout systems. A rising but more volatile market can still be profitable, but the risk is higher. A falling and volatile market, on the other hand, is pure chaos. It is better not to trade at all. The filter automatically turns the strategy on or off, depending on the current environment. This allows the system to trade only when it statistically has the edge. This filter can be created easily in any trading platform or directly in Strategy QuantX. You calculate the trend using the 50-day moving average, calculate the current volatility as the ratio of the average range to the price, and compare it with its long-term average. If the trend is rising and the volatility is lower than average, the system stays active. If not, it pauses and does not open new trades. That is all it takes to manage your strategy according to the market regime. Recognizing the correct market regime changed everything for me. It was not about finding a new entry signal or about luck. It was about trading only when the conditions were right. Try applying this logic in your own systems. Watch how your performance changes, and you will see your equity curve become smoother and more consistent. Thank you for watching, and I will see you in the next Quant Monitor video.